Good morning, everyone. Welcome to this update for global stocks for the 27th of September. And chart patterns are looking very poor at the moment. Now, August, September are normally fairly weak at times of the year anyway. You don't tend to get too much strength during those periods. So what we've just seen is very much to be expected. But rolling into October, October has from time to time seen some spectacular declines in the market. But equally, it also generally marks the bottom of the decline or the correction for the year. So at this stage, we don't know which one we're going to get. I'm a little bit cautious about some of the chart patterns that I'm seeing at the moment. They're just breaking down a little bit more than what I would have expected and what I would have liked. And whilst you might have a view on the market, you've got to be prepared to change your mind if the evidence is in front of you. And certainly the last week has changed my stance a little bit. So this is a really critical video to work our way through. So let's jump in and have a look. Just a thought for the day to start with, because this is a tougher period to be a trader or an investor, and they come along not infrequently. So my thought for today is that markets will either keep you honest and humble, or they'll drive you crazy and cause mistake after mistake. Unfortunately, most people fall into the second category. And one of the things you've got to do is, apart from being extremely clear about what your game plan is recognize that no matter what your view, the market can do something different. And no matter how logical and factual your view might be, the market can do something quite different and can hurt you very badly. And so that's why I've learned over the years to remain extremely open-minded, despite personally what I think based on facts and logical common sense. And we may well be in one of those periods now where you've just got to say, well, it doesn't make any sense, but it's reality, and we've got to go with it. So American stocks, the S&P was lower by 27 points on the week. I believe that more downside is the path of least resistance. Now, I've been talking about that for probably 2 months. We had the initial decline, we had a rebound was fairly weak, and now we seem to be breaking down into the third leg. So there's nothing new or different about that. That's perfectly normal behavior. But what is a little disturbing is the way that the markets and the sectors are breaking down. They're breaking down far more quickly than I would have thought. So the next support levels come in at the August flash crash lows, August 25, which was about 1867 on the S&P, and then if that doesn't hold, then the October 2014 lows around 1820 would also come into play. And I read something the other day which is well worth bearing in mind, and that is that in an uptrend, supports are expected to hold, but in a downtrend, supports aren't expected to hold. So I think that's a really important thing to bear in mind. You've got to expect to see support levels break. So don't trade or invest on the basis that a support level's coming up, so therefore the market must hold at that level. So at the moment, the market is very nervous. It's about uncertainty about a lot of things, and it's also the time of the year. So I think you have to expect some more whipsawing action for the next few weeks. And as I said at the start, it does go contrary to the US economic situation and the US corporate fundamentals and value. There is some terrific value in American stocks, particularly compared to Australian stocks. But ultimately, the price is king, and if the price is going down, then you've just got to go with it. So before we look at the Aussie stocks, let's take a look at the American market. So we'll start with the S&P 500. That's the monthly chart. There's not a lot of change there, as you can see. And at this stage, August and September are no different to August and September in 2011. So it's quite possible that we'll just get a weakness for a few more weeks and then march off again on a renewed uptrend. That is possible. But as I said, I think there's a bit of doubt around at the moment, and it's largely surrounding this part of the chart. Now you can see that the red moving average line, which is the 150-day moving average, has now rolled over, and the price is now basically living comfortably below that moving average. I would have expected in a market that was showing any kind of moderate strength that you would have seen the S&P maybe at least make it back up and maybe touch the 150-day moving average. Didn't have enough strength to do that. We had this wedge pattern developed after the August flash crash. We got a little spike above it on the day that the Fed made their interest rate announcement. But since then, it's been all downhill and it's broken that wedge. So on the S&P level, that is not exactly what we wanted to see. So we've got the next support level is the lows of August. After that, it's the low of 2014. And after that, we start to get down to some of the retracement levels on the big picture. So if we look at the run from 2011, which was the last time we had a major correction, then the 38.2% retracement comes in at 1728. And that's a fair way down from where we are now. That could do a lot of damage. Now, I'm not saying that's going to happen, but it could, the way some of these charts are developing at the moment. So that's why I think you need to take extreme care and be very clear about what you're doing at the moment. Now, the other American index that I just want to take a quick look at is the Russell 2000 index. And this is a weekly chart. So this dip back here is 2011. Now you can see that the index had maintained this trend line all the way through until about 4 or 5 weeks ago when it broke underneath the trend line. It rallied back to test that trend line. Again, normal market behavior. And now we're starting to fall away again. And last week, that's quite a sharp fall away last week. I'll just zero in on there a little bit closer. And you can see that if we put a retracement level on that whole run, that potentially we could have another 100 points perhaps out of the Russell 2000 index. Which would again do, a fair amount of damage to global sentiment. So it's not just about what happens to American stocks; it's about what happens globally. So that's the American market. I'll just look quickly while I'm here at the VIX index. So the VIX had a big spike with that flash crash. It's come back down into the low 20s and is just holding there for now. Now, just turning to the Aussie stocks. First of all, the Aussie dollar rallied on the Fed news, but then fell again. So it's all pretty normal action, and my view is that the mid 60 cents is the likely outcome area. The ASX 200 closed down by 128 points on the week, and it's still stuck within a downward-facing wedge within a downtrend. So technically, you've got to expect that the odds favour more downside. Now, the direction in the Australian market is a lot about how overseas funds see us. 40% of the Australian market is controlled by overseas funds. And at the moment, I don't think we appear too interesting to them, particularly with the likelihood that our dollar is going to fall further and that they would lose money on the currency. So you can think about it in very broad terms that 40% of the market isn't interested in buying. The other 60% of the market, which is the Australian investors, are still focused and interested on dividend yields. So there will be a point where the bank dividend yields will just become so attractive that people will step in and buy. But at the moment, it's hard to tell who's really winning that tussle between the overseas funds and what we're doing here locally. So look, this is the Australian ASX 200 index. So you can see very clearly the downtrend. We've now got this wedge pattern forming up within this downtrend. Just mark that up. So we've got that declining wedge within that downtrend. So you'd be pretty brave to say that this is the bottom, and this is a great time to be buying Australian stocks for dividend yield. Pardon me. It may prove to be, but what you'd want to do, in my view, would be to wait for confirmation. You really want to wait for a break. You want to see the Australian index up above probably 5,300 before you could start to feel confident and comfortable about the Australian market. Just look quickly at the Australian dollar, still in downtrend, still well below the moving average, so absolutely no sign of a change in behaviour for the Australian dollar. Turning to commodities, gold rose by $8 for the week. It's still on a longer term sell signal, as you'll see from the chart, but on a daily chart we do have a short-term rising channel, and that's what's got some commentators and gold bugs a bit excited. But when you look at the bigger picture, I still don't see anything at all there that's indicating that we're going to see a continuation of positive moves in gold. And one of the reasons is that gold stocks are not confirming a change of trend. Gold stocks almost always lead the underlying metal in both directions. So there's just no evidence of that, as we'll see when I look at the chart. So we'll go first of all to there's the weekly chart of gold. So you can see we've got a long-term rising trend line that at the moment is still intact. We've also got another key support level here at 1,020 should that inclined trend line break. But you can see at this stage there's really nothing happening, and hasn't been for about 6 or 8 weeks. We just remain within this little consolidation here. If we go to the dailies, you can see, yes, there is an uptrend on a daily basis, but it's very short term, and it really needs to break above 1170 to get me remotely interested. But the reason that I don't think that's going to happen is because this is the gold stocks. So this is the HUI index in America, and you can see there's absolutely nothing going on there at all. So I don't think we're yet at a position where you want to be doing anything with gold. Simple as that. Copper down to $2.30. Not a lot of movement there. Crude oil was steady at 45, but as I've been saying, I think further declines appear to be likely, and I would still stay well clear of energy stocks. Again, commentators are starting to come out, and they're starting to encourage people to try and pick bottoms in the oil market. Just my strong recommendation is don't do it. I think it's too early. There's the spot copper chart. So just to wrap it all up, there's a lot of irrational behavior going on in the market at the moment. And one of the prime examples of that is Hillary Clinton last week put out a tweet that the cost of pharmaceutical drugs in America was too high and she was going to do something about it. Now, the whole biotech sector has sold off quite sharply. Now, last time I looked, she hasn't even become the nominee to run for president. She's not president. She hasn't presented any sort of bill. So for the market to respond to a tweet that she sent just shows you how irrational things are at the moment. But in irrational markets, prices can do crazy things, and hence my caution about how things might unfold in the next month or so. I still think that a W bottom is a likely outcome. So we've had the first leg down in the W. We've had the little bounce. We're now getting a retest. Whether we'll go to a lower low or not, I don't know. I still don't believe that this is going to be the start of a bear market. I can't accommodate that concept at all. But we could still see a sharp move to the downside. There is strong value in several sectors, but you really do need to wait for confirmation. There's continued conflict between the fundamental data and the chart patterns, and you can't afford to ignore what the chart patterns are telling you. So finally, just to wrap it up, this is a time of year where you just got to be prepared and only buy quality and value, and this is where having the courage of what you're doing is really, really important. Keep it simple, know your game plan. Most people that I have dealt with over the last 2 decades haven't any idea what their game plan is. And if they do sort of have a bit of a game plan, then they flip and flop from one to the other, depending on what the market is doing or what they've just read 5 minutes before. That sort of behavior will get you into a lot of trouble in this market. Obviously, members of specialist share education understand all this and are well set up. If you're a non-member of specialist education and you find yourself not doing as well in the market as you'd like to, then I think there's a lot I can do to help you. There's my contact details, and let's see what another fascinating week brings. Cheers.